Hello, my name is Jack Elder, Senior Director for Advanced Planning with Comprehensive Brokerage Services. Today I'm going to talk about premium finance. Premium financing is a complex subject that is a great tool for many clients, but it's complex. So I'm going to break it down into two parts. In today's video, we're going to talk about premium financing in general, the client profile, go through the basic case design, and an example. On my next installment, we're going to talk about premium financing administration, which is what happens after that policy's been put in force, because the success of a premium financing case depends not on the upfront delivery and sales. It depends on the back-end service and administration. So I've broken it down into the front-end process and the back-end process. Today, we're going to talk about the front end. So let's jump into it. First and foremost, here at CBS, we believe in comprehensive planning. We are not a one-stop shop for premium finance. Premium financing is a means to an end, not an end in itself. We have 15 years of experience with 20 plus premium financing cases per year. So that's a lot of premium financed policies on the books. But we turn away more than we actually accept because we want to protect our persistency. Out of all the policies that we've been a part of putting on the books, only one premium financing policy has not made it to planned exit strategy. Only one. And that's because the client had a better opportunity with the funds. We want to protect our persistency because it helps our clients get exceptions from carriers and lenders. Carriers and lenders trust us because the policies we market stay on the books. That's in part because we have an exhaustive front-end process and a service-driven back-end administrative process. Today, we're going to talk about that front end. So the right client really fits into one of three categories. They have earmarked or used their lifetime exemption, but they still need insurance outside the estate. Clients that are getting high returns on investments that don't want to liquidate those assets to cover the cost of premiums, and then clients that understand and have used leverage in the past. That would be entrepreneurs who have borrowed money or investors that utilize margin to enhance their returns. Clients that fit that profile, that are high net worth, premium finance is a good conversation for them because it's got several unmatched benefits. Internal rate of return on the death benefit, minimizing the out-of-pocket costs, maintaining capital for those high-returning investments, and importantly, alleviating gift tax pressure. Rather than making a gift of the full premium to trust, a wealthy family can make a gift of only the interest to cover the financed premium. These benefits, though, come with some risks. You're borrowing money, so you have interest rate risk. You need to maintain creditworthiness. In most cases, the client can expect to post collateral. So you've got collateral at risk. And then you're relying on the policy to perform. So you've got policy performance risk. A client that understands the benefits and can absorb those risks is a great client for premium finance. So let's go through the structure quickly. We work closely with the advisor and the client to identify the best lender, and there are many, and the best carrier to meet that client's goals. While that's going on, typically, in most cases, the client is setting up a trust. Most premium finance is wealth transfer and trust owned, but some of it is income produced, is supplemental income. In most cases, it's trust owned. The trust is the borrower, borrowing from the lender. If the trust isn't capitalized, and a new trust wouldn't be, then the client provides a personal guarantee, collateral, and obviously pays interest to the lender. In exchange for interest payments, the lender advances a premium to the life insurance company who issues an IUL or a whole life, something with cash values that aren't going to go down due to market conditions. Over time, the cash values grow. When they grow enough, it eliminates the need for outside collateral. And these are designed as short pays. So as at some point early on in the process, somewhere between 3 and 10 years, no more premiums are due. The cash value continues to grow and eventually pays off the lender, leaving the policy in a trust for the client, or if in the more rare but still, something that we do and help clients with in a supplemental income scenario, just a personally owned policy that's paid up with high cash values. So that's the general transaction. It's pretty detailed when you get into it. We'll help you model the initial design, present it to your clients, other professional advisors, help with carrier selection, lender selection. The lenders are constantly changing their programs. You cannot stick with one lender. You've got to shop the market. We use all the lenders. We're not married to one. We're not married to one or just a few carriers. We work with all of the carriers in the premium financing space. We'll walk you through every step on the front end, and as I'll cover in my next video, help you administer every aspect of the case on the back end. So let's take a look at a case so you can see the power of premium financing. This couple, it's a second marriage for both of them. He is an entrepreneur and has used up his lifetime exemption. Her exemption is earmarked for other assets. Because all of their income is going back into the business or being spent, they have a very small budget for life insurance. Their goal was to get the largest death benefit possible for a budget, in this case, for under $150,000. So let's look at what we put together for them. In this case, the budget was $150,000. I mentioned our unparalleled persistency earlier. We went to the carrier and said, and got an exception to cover 4 years of interest, which was less than $150,000. So we used kind of this as our speed limit to buy as much death benefit as we could outside the estate for less than $150,000 over 4 years. We were able to secure $14 million worth of death benefit at her life expectancy. This was a policy on her life. That's a tidy internal rate of return of 14%, by the way, which is in line with returns this client is getting on other assets. We financed a 10-pay, all premiums financed, with a rollout in year 20. Typically, we'd like a rollout earlier, but in this case, because the client's out-of-pocket was so limited, we had to, roll out later than we would typically design. Every premium financing case we do is 100% tailored, customized, and bespoke for each client's goals. So for the first 4 years, the client paid interest. For the next 16, the client accrued interest. We showed borrowing costs increasing annually, starting at 3% and then increasing annually. This is how we designed it, showed it, stress tested it. In reality, after getting to the finish line with the lenders, we were able to secure a rate of 1.8% in year 1. So we kind of undersold and over-delivered from the very start. The clients got collateral requirement because we did not use an early cash value rider. So the shortfall, the difference between the loan and the cash value, represents the client's collateral requirements. And as you can see, over 10 years, that requirement starts to burn off in year 11. While the loan is in place, understand that the lender stands in first place with respect to the death benefit and the cash surrender value. In year 19, we're forecasting you can withdraw from the policy enough funds to pay off the outside lender, which leaves a tidy death benefit for the family of almost $14 million at her life expectancy. There's 2 factors we can't control, 2 factors that occur in the future. One is the cost of capital, and the other is policy performance. So when we run these designs, we run them in a multitude of different lending and crediting environments. And the fact of the matter is, the policy must be designed to succeed in a sustained low return environment. And you need to have realistic lending terms. so that the client can understand their risks. What can happen is it's possible that you would need to increase the premium, delay the rollout, increase the collateral, or reduce the face amount if either the projected borrowing costs are higher than expected or the policy doesn't perform. The client needs to understand that. In this case, the client has already used leverage to enhance the value of their business, and they see the benefits of limiting their budget and yet being able to provide their family with a very large death benefit outside the estate. 14 million is very large relative to $150,000. So they're the right client, and that's the key. Do you have the right client? And if you do have the right client, you got to make sure you have the right partner, and that's us, Comprehensive Brokerage Services, because we view insurance, premium financing, as a tool, not the tool. We'll help you with every aspect on the front end, and we're in it for the long haul, and we'll be with you and your client until that third-party loan is paid off. Please don't hesitate to reach out to us if you have any questions about premium financing and how we can help your clients buy large policies without having to pay the entire premium. If you have the right client, this is a great tool.